This class we will be talking about qualitative measures which are undertaken in order to regulate the supply of money and credit in the economy. The three qualitative tools in the hands of the Reserve Bank of India are: number 1, the margin requirements; number 2, moral suasion; and number 3, selective credit control. Talking about the first tool, that is margin requirements, in simplest of term, it is the difference between the amount of loan which has been asked for and the value of the security. So if you are going to take a loan from the bank will ask for a collateral. Suppose the collateral is your house. Okay, so you will deposit your house paper, and suppose the value of your house is rupees 10,000 crores and you are seeking a loan of rupees 10,000 crores. Do you think the bank will give you loans to the tune of 10,000 crores? A big no. Why is that so? Because banks also want to be secure regarding the loans they are offering to us. They want to make sure that in the eventuality of you not being able to pay the loan, they will be able to retrieve the value of the loan from the asset you have given as security. So, no bank will give you loan equal to the full value of security offered. So, how will Reserve Bank alter the margin requirements? The Reserve Bank will alter the requirements as per the economic activity in the economy. So, if it wants to reduce the economic activities in the economy, it is going to increase the rate, that is, it is going to increase the margin requirements. If it increases the margin requirements, it will reduce the borrowing capacity borrowing capacity and the money supply The second case is if the banks decrease the margin requirements. If the banks decrease the margin requirements, it will increase the borrowing capacity and encourage the people to borrow more from the banks. At this point, we must remember that RBI prescribes different margins for different types of borrowers against the security of the same commodity. The second tool in the hands of RBI is moral suasion. Now, moral suasion is a combination of two things, both persuasion and pressure that central bank applies onto the commercial banks. Now, why should commercial banks listen or follow the guidelines of the Reserve Bank of India? Because you know that RBI is the lender of last resort, which we have studied under functions of the bank. So if commercial banks does not follow the guidelines which the RBI is from time to time giving to the commercial banks, in case of financial emergency or in case of any kind of help which the commercial banks want from RBI, they may not be able to get that required help. Second thing which we must remember, these are just guidelines. It's not binding on them, but by practice, most commercial banks will follow the guidelines which the RBI is sending through discussions, through letters, through speeches, and basic guidelines to the commercial. The second thing, as I have repeated now, is it's not binding on the commercial banks, but most commercial banks will follow these guidelines which the central bank is issuing from time to time, and it will make sure that most commercial banks, in fact all commercial banks, follow the guidelines and policy which the RBI is suggesting the commercial banks to follow. The next tool, a qualitative tool in the hands of RBI, is selective credit control. Selective credit control meaning to give or not to give credit for certain purposes or people or sectors of the economy. So if the RBI wants to encourage growth of certain sectors, maybe educational loans, maybe the backward sectors, then it will make a policy so that these sectors of the economy are given special attention while the banks give loans. On the other hand, if RBI wants to discourage loans to be in certain sectors of the economy, then in that case the RBI will suggest that loans be made expensive or to be given in a way that people will not be encouraged to take loans for this particular purpose. For example, if it is some tobacco industry, they can charge a high rate of interest. So this way, either the person will not take a loan, or if he takes a loan, he will be paying a very high rate of interest. So this is what is selective credit control. The last function of RBI is custodian of foreign exchange reserves. The central bank of the country holds the stock of gold and reserves of foreign exchange. Stock of gold and the stock of the reserves of foreign exchange. So all the foreign exchange of the country is routed through the RBI. The objective of centralizing all the foreign exchange transaction has number of benefits. The first objective is that it will stabilize the external value of the currency, and the second objective is it will help in pursuing a coordinated policy towards balance of payment situation in the country. So this is the last function of the RBI, that is custodian of foreign exchange reserves. Before we conclude the lesson, we would now conclude the lesson by drawing a comparison between the role of central bank and commercial bank. And the second thing which we will distinguish is the quantitative and qualitative methods to control credit in the economy. This is the last part of the lesson, and we will conclude the lesson after discussing these two segments. So the basis of difference for the difference between the central bank and the commercial bank, we'll be talking on the basis of these guidelines. First is the formation of central bank. We have studied that the formation of the RBI was done by the RBI Act in 1934 and it was established in 1935. The commercial bank was formed by a Banking Act of 1991. Regarding the number of central banks, there's only one central bank in the country, that is the RBI. When we talk about commercial banks, there are several commercial banks in the country. You have Punjab National Bank, you have State Bank of India. So number of commercial banks are there. Talking about legal entry, central bank is the supreme legal power and authority. But when we speak about the commercial banks, they have little legal authority. All the power is vested with the central bank, and central bank issues guidelines as to how the commercial banks are supposed to function. Regarding the fourth point, it comes from the third point. The central bank is controlled by the government. Talking about the commercial banks, we've studied the structure of the banking system. We have the central bank, then we have the commercial banks. So we can say that the commercial banks are controlled by the owner or the central bank. Talking about general banking systems, we are here. So it is the commercial banks who are in touch with us. The central bank we have no contact with there's no contact between the public and the central bank. So the general banking functions are not performed by the central bank. It is on the contrary performed by the commercial banks. When we are talking about general banking activities, it is basically accepting deposits and giving loans. So this is performed by commercial banks and not the central bank. The next difference is the branch of central bank is situated within the country. The branch of commercial bank may be situated abroad. You don't have an RBI office in Kuwait. You have an RBI office within the country, but you may have commercial bank offices, for example, SBI branch abroad. The seventh difference is the main objective is to maintain stability in monetary system. So the main idea is basically to regulate the supply of currency in the country and to stabilize the value of the currency. But for commercial banks, the main idea is to make profit. You have done credit creation power of commercial banks. So the main idea of credit creation is to make profit. When we speak about note issue, we have done it several times. All the notes are printed by the central bank of the country except the 1 rupee notes and coins. And when we talk about commercial banks have no power to issue any kind of, to print any kind of currency notes. The to provide loans, it provides credit to scheduled banks or the government, and the commercial banks we are in touch with the commercial banks, so they provide loans to us. Speaking about the next point, that is credit control, they take effective steps for credit control, and on the contrary, commercial banks help the central bank in credit control. The guidelines which the central bank is giving from time to time through the quantitative and qualitative measures helps to control the volume of credit in the economy. The next difference is on the basis of clearinghouse. The central bank acts as a clearinghouse for all the local commercial banks, but the same power is not given to the commercial banks. Commercial banks cannot do the function of clearinghouse. The last one is that central bank is the final controller of foreign currency, but in case of commercial banks, it can exchange foreign currency by purchasing it from central bank. So that it's not that you go to the central bank when you need foreign currency. You have to go to the commercial bank and complete all the paperwork and formalities if you need any kind of foreign currency. This is the last topic, and we conclude the lesson with quantitative and qualitative measures for credit control. Quantitative tools we have already done are bank rate, repo rate, reverse repo rate, open market operations, cash reserve ratio, legal reserve ratio, statutory liquidity ratio, and these are general in nature and affects all sectors making use of the bank credit, and they help in regulating the volume of credit. They are also known as traditional methods. Talking about qualitative credit control, they include measures like moral suasion, selective credit control, margin requirements. The difference is that these tools are specific in nature as they affect the flow of credit for specific use, as they affect the flow of credit for particular use only, and they are designed to control and regulate the direction of credit. So in this lesson, what you need to do, children, is understand the credit creation power of the banks, the commercial banks, and focus on learning and understanding the functions of Reserve Bank of India, including in detail the functions with respect to quantitative and qualitative methods of credit control.